Jitendra Shriram is Director and Head of Research at HSBC Securities and Capital Markets, joins us right now. Jitendra, thanks very much. Good morning. Prashant this side. Let's start with the obvious, Infosys. What did you make of the numbers?
Good morning, Prashant.
And how are investors likely to see what the stock does from here?
Well, I would argue that, given that it is the first of the earnings season, the sequential growth or posted has been a little ahead of consensus. So to that extent, I would reckon that it has set up a good tone for tech sector results. And clearly what we do argue is that for the sector as a whole, there is clearly a tailwind of margin uptake coming from the fact that you had a quite a severe rupee depreciation through last year, and that should facilitate margin expansion going through into this year, and that should benefit the sector going forward. And even from a slightly medium-term perspective, the fact remains that you have the backdrop of a Fed taper, which means flows might be tested going forward, and current account deficit, okay, magnitude wise it has come down, but it is not a problem that has gone away from the economy. So I would suspect that it will keep the pressure ongoing on the economy, and as a result we do like exporters as a segment.
You bullish on Infosys, Jitendra, specifically?
Yeah, we are positive on Infosys, although our top pick in the sector is TCS at this point of time.
Right. No, I mean, the stock has done phenomenally well. Demand environment is strong. Rupee is weak at weak levels. I mean, so those are strong tailwinds, I guess. But what would you, there has to be some explanation from the company on the slew of exits, top management exits at the company. Do you worry about that, Jitendra, or do you hear those worries from investors you talk to? I'm sure you do, but the fact is that people still buy the stock, own the stock, and are betting on the stock. So it's not getting translated into the stock price, the worries around these exits.
Well, I think the good part about most of these large tech firms is that the depth of management is quite high. So, whether it is senior level management across the whole spectrum, you have quite a lot of senior people. So, a few exits may not matter so much. It could have a little bit of a marginal impact, but whether it is very debilitating to the firm, I don't know whether it is really true, because these are quite large enterprises, and so I would suspect that their middle and somewhere between the middle and top level management, there is quite a lot of depth in them to make sure that transition is fairly smooth. So I don't think those would be so much an issue per se in terms of managing the growth. In fact, I would reckon that, if sales team actually, the actual direct line which interacts with clients, actually there is a lot of attrition, maybe that can be a hiccup to short-term growth.
Okay, got that. Banks kick off earnings. IndusInd reports today. Q2, there were lots of worries after what happened in July and August, but Q2 was largely stable. Profitability did not crack, especially at private sector banks. I mean, they kind of held up. What's your sense? Third quarter, both profitability and asset quality as far as banks go?
Well, I think from a profitability perspective, there is clearly some reason to believe there will be an uptick because, all these exceptional measures that the RBI imposed on the bank So that should be an area where you could see some positive surprises come through.
Right. Jitendra, just, the overall picture right now was that, ahead of general elections, you would see that rally happening, the run-up to elections. And the three Gs that everyone's been talking about is the general elections, growth, and the global factors. How much precedence and importance are you going to be giving to each, and in the order of that?
Okay, I would say that, from an election rally, I would argue, actually, contrary to what you said, I think a lot of the rally was getting priced in pre-state elections. In fact, with the kind of performance that the Aam Aadmi Party showed through in the state elections, I would reckon that the field has become a little bit more murkier than what it was. Clearly, the market is starting to build in an assumption that will there be any party that gets to the 200 seat mark now after this, because obviously, you add one more ingredient to this multi-party contest, and you have some more seats getting sniped away, in which case whether the two large parties anybody can reach 200 is going to be a question mark then. And I think those concerns are now coming through in the market from an election perspective. So I would argue that it is going to be a little bit more difficult to argue conclusively that you could have a strong coalition as a result of an emergence of one more party. The second issue I would say from a global perspective, well, short term, it may not have too much of an impact from a perspective of flows, which is the Fed taper. But longer term, the impact may not be felt near term, because even at this point of time, you are seeing incremental purchases. The real pain point will start once, October, December, give or take a couple of months, is when the Fed balance sheet starts coming off, when the redemptions or the maturities on the balance sheet are more than incremental subscriptions. And when the balance sheet starts shrinking, what happens to flows? Do give a note to the fact that US yields have already bounced beyond the 3% mark now. So clearly it is showing higher yields coming through, which is either a reflection of growth or the fact that, surplus capital is probably going away. So to that extent, I would say that it could mean that global cost of equity everywhere starts to inch up moderately, which is not really good news for equities. And India remains current account deficit, so we will be tested on flows. So I would pay that factor a good amount of heed. And the last thing about local growth, I think, economy-wise, we are in a bottoming out phase. Now, I really don't think we are in a V-shaped recovery right now. It's going to be a more prolonged recovery. Couple of factors why I believe so. One is that, from a fiscal spending, we could use a lot of one-off levers this year to hit that 4.8, 4.9% target, which is that, you could have a SOOTI sale, or you could have one-off big ticket divestments and so on. But these are clearly not sustainable from year after year perspective. So I would say that, you will have some transfer of expenses from this year to next year as well on fuel subsidies, reform, SEB subsidies and so on, which will make next year's equation a lot more difficult to balance, and you may not have the one-off levers as well. So I would say it's going to be a more prolonged recovery, which clearly is not going to be very positive for markets in that regard. We are actually underweight India from a regional context in that regard.
How concerning is the fiscal scenario right now? We are already 94% of the budget estimate.
Well, I would say that, there is possibility of some slippage. In fact, we are saying that the government will probably exceed its target of 4.8 odd % by maybe about 20-30 bips for the year. But, there is obviously, there is spectrum auctions coming through potentially next month. You have, big ticket divestments which are lined up, like say a Balco or a Hindustan Zinc, and maybe some kind of one-off sales like a SOOTI and so on. In case these one-off items come through, you have a chance to balance that. But are these sustainable flows? If one asks that question, I think clearly not. And there is obviously, because the government follows a policy of cash accounting, you will have some of these one-off, the subsidy on oil, etc., getting deferred into next year, which will make next year that much more difficult to balance.
Talking about oil, we have been seeing calibrated increase in diesel prices of late on a month-on-month basis. Do you think that can continue through to general elections?
Well, it is little difficult to say that. I mean, I can only go by precedence. You know, we did have some pause around the state elections as well. Maybe about a month in advance, you didn't see too much of, you skipped one or two possible hikes. So if I were to extrapolate that same argument, I would say that, you know, maybe we could see those impacts till about April or so, and maybe then some maybe skipping of that hike for probably 1 or 2 months. So the fact is, you know, from a year before perspective, we have done quite a serious amount of hikes. But the problem is so much acute that because of the rupee depreciation, the deficit in absolute terms, which is about 10.5 rupee on diesel, continues to be as is, whereas it has not changed at all. So really speaking, you need probably a 5 rupee, probably one-time increase like what you did in September of 2012. But I don't think anybody has a spine at this point of time to do that. So it is clearly a problem in terms of planned spending issues, because with a 1.4 trillion under recovery or a millstone around the government's neck, the problem is there is very limited ammunition left for capital spending and productive spending. So anybody who needs to come in will probably need to address this at some point of time.
Okay. You know, just from an investor point of view at this juncture, would you recommend that one starts looking at giving more prominence and importance to high beta and cyclicals in the portfolio? Because last year was all about defensives. If you had these high defensive FMCG names, pharma names in your portfolio, you've done your bit. You've gone laughing to the bank. But now, if you do see a cycle change, does it mean that you need to be prepared to make sure that you capitalize even with a bigger move in the beta pack?
Well, I would, I think there is a little element of truth, but probably not indiscriminately. The reason I say that is, well, it's not going to be like a very sharp turnaround that you're going to witness in the economy. So it's going to be a very slow recovery that you're going to see. So, you know, the kind of runs you've seen in fourth quarter of last year, I think it's difficult to sustain those kind of recovery in the high beta names. Interest rates will remain high. In fact, we are forecasting that through the year you could potentially see another 50 basis point of hikes, and high beta typically is also usually associated with high leverage. So to that extent, it will have a little bit of a puncture in the story when policy rates do rise. So I would be a little cautious on them. If I look at the sectors that you mentioned, I would definitely remain positive on the exporters, given that we are structurally current account deficit. There are, if I look at the last 20-25 years, there are probably 90% of the occurrences we have in current account deficit, and we cannot look at it being a situation of balance. Now, the other issue is local factors, whether you should back consumer staples and others. Maybe this is a time to turn very selective on them, because domestic economy is slowing. You are seeing some margin pullbacks also happening, people down trading as well, and it is going to be a little bit of a challenge from a domestic perspective. I would be like, if I look at the infra space, yes, on the high beta space, manufactured exports could be an interesting opportunity, whether you want to look at auto ancillary space there, whether you want to look at some engineering proxies there. I would definitely be positive on them. I think if I take a 6-month out view, I would say that anybody who comes in middle of this year will have to address reforms, subsidies and so on, because it's just become too big and too unmanageable. I would be positive the energy space, probably some parts of the utility space as a result. And I would be positive on the margin even on the metals names, which are end of the day dollar linked pricing. So I would take, especially the non-ferrous part of it, we are more positive on. We are not positive on the ferrous part of it.